For example, if you live in Pennsylvania and you buy a bond from a municipality also located in the state of Pennsylvania, generally that interest will be tax-free to you as well. As soon as we hear that, it sounds like that's the way to go, right? We all want to pay less taxes.
There's less taxes.
We
right?
love less taxes. Hello and welcome back to the Future Value Podcast. As always, we're your hosts, John Pellosie, Justin Ahner, and Joe Freemont. Today, we're going to start a multi-part series of videos on investing. And obviously, this is a huge topic when it comes to financial planning and planning someone's money. And we really want to give people a foundation to understand the basics of it, what it is, why we do it, what all of these different terms mean, and hopefully help create for people a strategy that they can use to be successful in their investing lives. So where we're going to start today is really at the foundations of that. What are these different types of investments? What do these terms mean? How do we engage with them a little bit and just set the stage from there? So to get started, Joe, I know you're going to kick us off with kind of setting the table and setting some definitions for us.
Well, first, I just have to say this might be our most highly anticipated episode yet. So I think this is, when we talk to our clients about financial planning and everything, everyone always wants to talk about stocks. Everyone's like, oh, tell me about stocks, tell me about bonds, tell me about investing. But I think we all need to just take a step back and just kind of get to the basic 101 of it, which is, what is a stock, right? Well, put simply, a stock is a form of equity or a share, a partial ownership in a company that you may purchase on maybe a brokerage platform or some sort of market, what we could say the secondary market, right? And there's several different categories of stocks if we think about it, right? There's large cap, mid cap, small cap. And when I say cap, I mean capitalization, or how big, if you added up all the shares in the company and times it by the market price of it on the index, which you can find anywhere on Google, and how big is that company, right? So small cap is around $250 million to $2 billion. So I wouldn't say that that's quite small, right? We're not talking about
That's still a pretty big company.
I would say so. It's not your ma and pa shop or your diner or something that you're seeing around the corner. But mid cap is anything from $2 billion to $10 billion. And then anything above $10 billion is what we would consider to be a large cap company.
So, Joe, you said something right at the beginning about, stock is a position of ownership in a company. So that means that, if we buy Apple stock, Coca-Cola stock, we're an owner in Apple and Coca-Cola.
You're right. I mean, I compare it to, let's go back to that mom and pop shop that I was just talking about, right? If you're the owner of that store, right, you are the sole owner, right? And that means that at the end of the day, you're liable to yourself and hopefully your employees that you're paying for that, right? But when we think about shares, there are multiple peoples of shares. When you own a share of Apple, John, you're a very minuscule owner. I hate to break into you to that, but we might feel cool when we own that share of Apple and say, hey, well, that iPhone that I have, I technically maybe own a little teeny tiny part of that, right? Mm-hmm. But in reality, the scale is so massive that they have to be accountable to all the owners in their company when they own that share, right? Mm-hmm. So, and actually, I think that brings up a good point is, well, how do we make money in shares, right? How do we make money in stock, right? And there's two ways that we can do that, which is, one, the appreciation of stock. Hopefully, all of us, when we're buying a stock, if we buy Apple, for example, at $100, well, we hope that someday it'll be worth maybe $150 or maybe even $200 over the long term of time, right? That's appreciation when we think about a stock, right? But the second way is a dividend, right? A dividend is excess profit that a company has that they don't necessarily need, right? Apple might not pay too much of a dividend. I know they have paid one in the past, right? But as a technology company, which we'll get into more later here, they have a lot of research and development to come out with the new and next iPhone, right? So, but if they had extra profit there, they would pay out what they would call a dividend. So that's the two ways that you can make money in a stock.
And Joe, on that price appreciation idea, right? The idea that the price, we start at a price that we buy it at, and then it's going to go up in the future. What would cause the price of the stock to go up?
Yeah, I think it depends on the type of company that you're investing in, but some might say a new type of technology comes out, right? So Apple recently came out with intelligence, AI, right? And everyone's very excited about AI these days here in 2025, right? But if they are looking to use that technology and people are very excited about that, and they show consistent earnings or growth on that, that would cause the stock's price to appreciate.
Okay.
Yeah, just from a fundamental standpoint, increasing profitability or increasing the amount of revenue is going to create a more attractive company. And it's also perception as well. If people think something is more valuable and are willing to pay more for it, the fundamental numbers might not have changed, but that idea of scarcity or just perceived value could also cause some appreciation there.
Right, and you actually brought up a great point, Justin. So every year, companies come out with metrics of profitability, right? And every year, it's a kind of a balance of, hey, here's what I'm going to tell my shareholders, what goal we're going to have, and whether they meet that goal or exceed it or go below is really a determination of how that stock price might be.
And so when we talk about the stock market or, the collection of stocks, maybe we should take a minute to ask you that question. So
Sure.
we hear this term like the stock market or Wall Street or whatever. What is that? What does that even mean?
Yeah, I mean, we're thinking about, I would call it macroeconomics. And for those of us who just shuddered because they remembered their macroeconomics class back in college or high school, don't worry, we're going to break it down for you here today. But we're thinking about the economy as a whole here. And we use indexes to kind of substitute when we say the market. So a very popular one that I'm sure everybody here will know, or if you haven't known about this, go look it up. It's the S&P 500, right? The top 500 companies in the United States, all domestic here, headquartered in the United States. And those 500 companies is something that advisors such as ourselves use to say, hey, how is the economy doing, right? That is the high level of it there.
Okay, so that basically that index, like the S&P or even a different index, it's like tracking the performance of like a subset of stocks over time.
You got it, John.
Okay.
Yeah.
Okay. Great. What are some other ways maybe that like investors categorize stocks? Like are there different kind of groups or baskets that they put them into?
Yeah. So I think something that we use a lot is it more of a growth company or is it more of a value company or maybe a little bit of a blend there, right? And just to kind of break it down a little bit, growth stocks for that technology. I think this is when everyone first talks about investing, maybe they're looking to open up a brokerage account. Most people think of these technology stocks, right? They're like, hey, I'm going to pick the next Apple and it's going to grow and grow and grow. And the appreciation is really the target there for that kind of growth focused stock, right? Typically, they don't really consistently pay out a dividend, right? They're usually reinvesting profits in research and development. But really, they're looking to grow over the long term. And usually they have some sort of competitive edge, right? That makes them different than their competitors there.
Okay.
Justin, do you want to talk to us about value stocks?
Yeah, so value stocks are kind of those steady Eddie companies that aren't quite as sexy. You don't hear about them as often. Procter and Gamble, Caterpillar, Coca-Cola. Those companies that they've had a long track record. They're very stable. They've been profitable. They're likely to continue to be profitable. But they're also not, cutting edge. Like they're not your Teslas or any of those big tech companies who are on the cutting edge of technology or, at the frontier of the individual industries. Typically, we see that there's a comparison there of, diving more into those fundamentals, looking at the actual book values and all sorts of those calculations that us nerds like, not so much for the individual,
Right.
But it gives you an idea of, as we were talking about earlier, what a company should be worth. And oftentimes you may find that companies are undervalued. You might see that there's some numbers that are saying, hey, that company, the current stock price doesn't quite reflect some numbers that I think or that I see. And that provides some inherent value in that purchase. Again, those are your high dividend payers as well. Again, they've had a strong track record of profit, and they pay out those consistent dividends as well.
Justin, when we talk about stocks and buying and selling on stock markets, is that like uniquely a a thing here in the U.S., or is that something that happens elsewhere in the world too?
Yeah, absolutely. I mean, there's quite a few industries and businesses around the globe, obviously, and there are lots of international companies that you can buy and sell as well as an investor.
Okay, interesting.
And not just international, we have emerging markets as well, right? So we think about that, right? There's domestic, international, and emerging market. Well, what does that mean, right? International is really the developed Europe world, right? And emerging markets, think of China, Russia, and anything outside of that there.
Mm-hmm. All right. Well, I like that. That's great. I think we did a great job, hopefully, of laying out the foundation for stocks and what they mean and what they do. Now, the other big asset category we often talk about with folks are bonds, right? Joe, maybe you could give us a different, like what is a bond? How's that different from a stock?
Absolutely. So a bond, when we think about it, at its very core is debt, right? So if it's an obligation from a company, hopefully you picked a good company or maybe a government entity that agrees to pay you a certain level of interest over an agreed upon time period, really, right? So an example that I always think of is if I had $1,000 and I'm willing to loan out this $1,000, I don't need it for the next 5 years. Well, Justin is going to offer me about 3.75% for this $1,000 because he's going to go and invest it somewhere else, right? Well, every year, Justin pays me $37.50 for 5 years. And at the end of that time, I get my $1,000 back and I get to keep all the interest from that bond.
So basically, it's a loan. It's a loan to a company or to a government entity.
You got it, John.
Okay.
Yeah.
And so, what are some of the characteristics there? I guess maybe we could talk more about like what types of entities are issuing these bonds.
Yeah. So we have the government, right? The greatest form of bond that we can get that has the absolute surety that we are going to get our money back, right? Because there's some inherent risk associated with loaning somebody money, right? Think about when you might loan money to a family member. Well, you don't quite know if you're going to get that money back, right? So investors, when it comes to bonds, they want to know that they're going to get that money back. And there's no greater issuer of bonds than the good U.S. of A, right? So a U.S. bond or a bill or a note, right? It's really the difference is the term, which we'll get into here in just a minute. But that's the absolute, we know for a fact it's backed by the full credibility of the U.S. government, right? So a government bond, a U.S. federal treasury bond, right? There's also at the state level government, right? So we call those muni bonds, which are tax-free interest, which maybe John will talk about here in just a minute. And then there's then there's corporate bonds, right? So think about from a corporation like Apple or Google or Amazon.
Yeah. And on the municipal bond side, a lot of times why these can be attractive to people is they can be generally federally tax-free. And depending on where you live and what kind of bond you're buying, it could also be exempt from a state income tax as well. So, for example, if you live in Pennsylvania and you buy a bond from a municipality also located in the state of Pennsylvania, generally that interest will be tax-free to you as well.
Now, John, when I hear the word tax-free, my financial planner senses are going off because we love tax-free things here as planners, right? Mm-hmm. But is muni bonds, are they suitable for everybody? Is there certain situations where you might not want to pick muni bonds just because you hear tax-free?
Yeah, great question. Yeah, I totally know what you mean. As soon as we hear that, it sounds like that's the way to go, right? We all want to pay less taxes.
There's less taxes.
We love less taxes. Yeah, but the reality is most of the time, for the same level of credit risk, muni bonds will pay a lower, what we call nominal rate, or you can think of kind of lower sticker price as far as their interest. So, for example, just to use an example, a muni bond might be paying 2.5%. At the same time, corporate bonds are paying 4 or 4.5 or 5%. Right. So each person kind of has to do an individual calculation of what their after-tax yield is going to be, or what we sometimes call the tax equivalent yield. So after I take out all of the taxes on the corporate bond, is it more or less interest than it would have earned on the tax-free? And it'll depend on what tax bracket someone's in at that point in time. So that's a great point, Joe. That's an important consideration people need to take into account when they're selecting the type of bond they want.
Tax-free might not always be for me, as they say. Yeah, believe it or not. Which is a sentence I never thought I would say, right? Yeah.
So Justin, speaking of kind of the types of bonds and the issuers, are bonds a long-term type of investment? Are they short-term, or kind of how does that work out?
Yeah, they can certainly be both. You can invest in bonds for a short period of time, but you could also get 30-year. The U.S. Treasury issues out 30-year. I think there's one that actually issues out 40 or 50 years. I'm going to have to double check on that, but I think there is an issuer that issues. That is a long time.
It's a very long time.
But yeah, certainly, you could tailor a portfolio based on your need and kind of the objective of what you're looking to do.
And so when somebody buys a bond or invests in a bond, what are they kind of looking to get out of that generally?
Typically, bonds are used for security in a portfolio and to kind of level off that volatility. If you're invested 100% in those growth stocks, you're going to feel that volatility a lot more than if you have some bonds mixed into the portfolio. Because again, they're sending out those coupons. They're paying you that fixed interest rate. So it's used to level out that volatility in a portfolio.
Gotcha. And that's a good point to segue into. Now that we've talked a little bit about what stocks are and what bonds are and kind of how they fit in a portfolio, how do people get diversification? Because I think probably we would all agree, it's great to be investing, but we don't want to just invest in maybe one or two companies. So I'll ask you, Joe, like how are ways that people maybe can get a little bit broader exposure to the stock market or the bond market?
Right. Well, I think that's a great question, John, because everybody thinks that they are the smartest person in the room, and they might say, hey, I know exactly what stocks to pick. But sometimes it's important to consider what professional management might do for you. And you can buy that through vehicles such as mutual funds. Okay. Right. So mutual funds, they do have a fee associated with them. But most places, there's no such thing as a free lunch, as we would say. Right. But you can purchase a mutual fund that has a certain investment goal. Right. So you would line it up with maybe your risk tolerance and time horizon, which we'll get into here in just a moment. But we'll say, hey, I'm actually looking for a well-diversified portfolio that might have not the most volatility, but not necessarily the most growth at the same time. And that manager that you have in the mutual fund will say, hey, you know what? We have the one that that best fits that situation. And it'll have a certain blend of stocks and bonds for that.
Okay. So basically the mutual fund is like, it sounds almost like kind of a pool, right? People are coming together as investors and then getting exposure to a wider basket of investments that way.
Exactly right. And if you really dive deep into what's in the mutual fund, it's a very large variety of stocks, and the price of the fund, to your point, John, is actually quite small in comparison, right? You can't get that level of diversification with the same exposure to that many stocks if you were to hand pick all of them at the same time.
I see. So it's a way, gotcha. And instead of paying $50 for one share of this and $60 for another, you can get exposure to all of them at a lower price point.
You got it.
Okay. All right. And Justin, on that topic, there's also, I think, this concept called ETFs that I think have especially become popular in the last several years. But could you share a little bit about how that ETF piece works?
Yeah, so exchange-traded funds, they function very similarly to a mutual fund, where it's a collection of stocks. Oftentimes, they'll track an index like the S&P 500 or maybe a specific sector. So maybe we want to target industrials or manufacturing or something like that. And again, similar, instead of going out and buying, I'm going to buy XYZ and ABC, you're buying into one fund that invests in those individual stocks.
Got it. Mm-hmm. Very good. So I think now that we've laid out a lot of those vehicles, maybe a good question to answer for folks is, why do I invest in these things? Why? Because we know that with investment, right, there's different types of risks that can come out, right? We invest in a stock of a company, and that company doesn't do well, maybe even goes out of business. That happens sometimes. Or, we buy a bond from a company or a government even, and they're not able to pay us back at the end. We call that the default risk. So why take those risks? That's something I get asked sometimes in our work, right? Why don't I just make my money, put it all in the bank, right? Earn a little bit of interest on it and be very secure. I think what it comes down to is when we look at many people's financial plans, in order to, number one, in order to achieve their goals, they have to be able to grow their money more than what would be available in a bank, right? In order to be able to retire someday, for many people, that money that they have is going to have to grow over time to be able to provide them with the level of income that they need in retirement if they're no longer working. And I think on top of that, related to that, is also the impact of inflation. Right. So we know that costs don't stay the same over time. And we also know that often the rate of inflation can exceed the rate of interest that's being paid on money in the bank, right? We see that happen very, very often. And with that, the issue then becomes people's money in the bank is actually losing purchasing power over time, meaning it's not going to be able to buy as much. So I think with that, we then have to look at these alternatives, stocks, bonds, mutual funds, and say, maybe we need to make a selection here. There may be a little bit more short-term, mid-term, or even long-term volatility, but it's going to help us get to our goal over the long run.
And John, I think that's an excellent plug. If you have not listened to our very first episode of the Future Value Podcast, where we go over the time value of money and the future value, right? I mean, go back and look at the price of milk and eggs 20, 50 years ago. It is quite different, and you hear horror stories all the time of clients whose parents might have only put money in CDs and money markets. And in that episode, we break down, hey, if you only earned this amount of interest over the long term, right, you need to be able to achieve that higher level of return, which might only be possible if you're taking a little bit more risk in your portfolio.
Absolutely. One thing we do, Joe, for our clients, we send them, we send the birthday card out on their birthday. And in part of that, we include a sheet that has all sorts of information about what was going on in the world on the day they were born and all that kind of thing. But part of that section is like a cost of living comparison, right? Where we're looking at the cost of eggs, the cost of gas, the cost of the average new home. And it's amazing to see. And obviously, salaries have changed over time too, of course. But it is amazing to see that impact of inflation. And to your point, that's why we can't, I think, just solely rely on cash savings for most people in order to achieve their goals.
I usually look at the price of a home, and I don't have a home just quite yet. And I usually go, hey, do you mind if I go back in time and buy a home when you were born? That would be really great. I can afford it finally.
So now we know what these investments are. We've talked a little bit about why we want to be investing in them. And then I think the question is, how do people make decisions around what to invest in? Meaning, do they buy a stock? Do they buy a bond? Or what kind of mix they use? So, Joe, what are the important factors people need to be thinking about for those decisions?
Yeah. So as financial planners, when we work with our clients, we're really trying to figure out what is your amount of risk tolerance that you're willing to have, right? And what's the time horizon for this money, right? How long is it going to be until I need to use these funds up? And in any given 1 year, how much am I willing to see my portfolio change in value, right? Mm-hmm. And that value can be on the upside and the downside, right? The more risk equals more reward, as they would say. So again, when we talk about time horizon, we're really saying, okay, when are these funds going to be needed, right? Are these retirement funds that, hey, maybe I'm in my 20s and I'm not going to use these funds for maybe 40 years, right? There's a huge difference between funds that maybe I'm going to use for a purchase of a home in maybe 5 years versus, hey, 40 years out, I need this to grow as much as possible because maybe I want to have an earlier retirement or something else, right? So maybe we're a little bit more regressive with funds that we don't need in 40 years or 30, right? Because quite frankly, if the stock market is down in any given 1 year, it doesn't matter. I'm not going to sell because I know I don't need it right now, right? So, I mean, simply put, you want to take less risk if you need the money sooner, right? Mm-hmm. And you want to take more risk maybe if you don't need it for a very long period of time. Justin, do you want to talk to us a little bit more about risk?
I was actually going to ask a question for the time horizon. Is there a specific time that it might make sense to invest versus not? Or, hey, I need to go buy groceries next week. Should I invest in the market today and pull it out for next week?
That's a great point, Justin. You most certainly don't want to be purchasing stock if you're going to need groceries next week, right? So I think that kind of goes back to our episode on cash management, right? So there are vehicles like money market accounts, not CDs for this just case right here, but you want to make sure that you're earning maybe some form of interest on reserves. But some things are good to keep in cash, right? Things that you need in maybe 1 to maybe 2 or 3 years that you're going to need, should it absolutely be in cash and not in the market?
Yeah, and I would just echo that. Typically my rule of thumb has been that 1 to 3 year period, or today, I should say today and 3 years from then, if you're going to need it for something, have it in cash or what we call a cash equivalent, something that's very safe. So savings, money market, maybe U.S. Treasury bills. We have some clients who, like, if they know they're going to have a payment come due in a year or something like that, they might use a U.S. Treasury bill because it's going to pay maybe a little bit more interest than what's at the bank, but be very, very secure. As you were saying earlier, I mean, the Treasury bill is basically the lowest risk investment you can find. So matching that time frame, I think, is very important. Definitely, you're absolutely right. Short-term expenses, definitely don't want to be trying to invest to have the money grow before that.
And that's the worst conversation to have with your wife. You're like, hey, honey, sorry, we can't afford groceries next week. I put it all on Tesla, and unfortunately, it's down this week.
So, yeah.
Eating rice and beans, like
rice and beans. Yeah.
Well, and I think in a future episode, we'll talk even more in more detail kind of about the stock market and stocks behavior over time, right? How they might work in the short term as far as performance versus longer term trends. And I think that's very important for people to understand and so they can make the best decisions. And we'll definitely be talking a little bit more about that in the future.
And then one last thing before we let you all go here today is risk tolerance, right? Like we said, more risk equals more reward, and less risk equals less reward, right? Because you're not being compensated for that risk that you're taking. But something that we use a lot as financial planners is we sit down with our clients to kind of get a better understanding of saying, hey, maybe you should answer a couple quick questions for us to kind of gauge how much risk you're really willing to take, right? And some of these that I think are really important, I've only picked out maybe about 3 here today for us to talk about, is if your funds were to ever have a temporary decline in 1 year, can you cover your immediate expenses from other sources, right? So really this goes to, am I still working, right? Am I living off these funds, or am I, independent from them, right? Or, you got to make sure that I'm going to be able to buy those groceries next week, right, Justin? So another question we often ask is, hey, hypothetically, if you had a $500,000 portfolio and you invested it, here's a couple sample portfolios, and we're going to put an image up on the screen here. Which portfolio would you like to see here? And as you can see on this chart that we're showing, portfolio 1 is one that has almost zero risk, right? On the worst case scenario, it might be down around -3%. But on an average year, it might be up 3%, or maybe at the most it could ever possibly be up is around 8%. So that's portfolio 1. And you can see we take more risk as we move over to the right on this image here, right? Portfolio 2 might be down -13% in 1 year. Portfolio 3 might be down even -27%. Are you going to be able to stomach that risk if you see your portfolio down -27%, right? I think it's a very important question to ask yourself. And really, it's just, are you comfortable with that volatility, really?
And one thing I'll add is that I think sometimes people going through this exercise can be very, very helpful. And I think it's also can be helpful for people to talk to a professional in this space to help them understand their risk tolerance. So behaviorally, as humans, we are very risk averse. And the pain of a decline we hear is much more severe than the joy we might experience in the upside or growth of our money. And sometimes that intuition is not helpful in investing. So I do think it's also can be an important thing for people to meet with a professional who can help them really assess and understand their risk tolerance. and make sure that it's based on facts, based on the logic of their situation, and not just the emotional kind of side of it as well. Well, thank you again to my co-hosts, Justin and Joe, for joining me today. Thank you all for watching as we kick off our series of videos on investing fundamentals. Stay tuned for future episodes here where we'll dive into some more details, talking about different types of investment accounts and, again, some different strategies and thoughts around the behavior of investments over time. Thanks again. We look forward to seeing you soon.